I think election day actually was a kind of liftoff point for what I consider to be the last stage of the melt-up. I've been saying for 2 years that we'd be in this melt-up and that the last stage would go parabolic. And I think we saw that week of the election after Trump won that it did move up pretty aggressively. We're up 5% on the week, I think. So I think that is the beginning of the parabolic. Doesn't mean it's going to go up every day or even every week, but it's going to be a steeper part of the rally. I think we've been in the melt-up for the past year, and it looks like it's proceeding as scheduled. I have a target on S&P now of 7,500. That's probably up from when we last talked, and the 25,000 target for NASDAQ. And Dow, my target is 55,000. The Russell, which has been the laggard, is now catching up. It looks like it's taking the lead, which is what I had predicted, that we would see a broadening of the market into the small caps. We're now approaching, we haven't already touched the new highs on the Russell going back to late 2021. So it's been the one market that had lagged, and now it's starting to kick into gear. I have a target on the Russell and have had all year of 3,300. I think if anything, that's going to prove low. So, if you calculate those targets, basically I'm calling for 25 to 40% upside from here. So we're in the last stage, but that last stage I think is going to be basically parabolic. So things are in pretty much along schedule as far as I can see. I think the bond market, which has corrected pretty aggressively since the September rate hike, is now looking like it's finally finished that correction. Backed up. The 10-year had come down from 5% down to 360 and backed up to 450 in the last couple months, and now looks like it's rolling back over, and I expect to see the 10-year down below 3% in the next few months, and ultimately later on with a much weaker economy could go down to zero. So that's not a misstatement. I think we could see a 0% 10-year sometime later, probably last quarter of next year. And the dollar, which again has been in a counter trend consolidation or correction for quite some time now, that looks like it's finally rolled over. And I think you're going to see that once it gets down below 100, it got up to 107, I think, maybe a little higher. Once it gets down below par, down below 100, I think you'll see it start speeding up on the downside. So, everything's pretty much in gear as I see it. Weak dollar, lower rates. In spite of people worrying about inflation, the Fed is still, I think, in the beginnings of an easing cycle that will continue through next year. It's basically a 42-year secular bull market. It started in August of 1982. I think we're in the final stages of that. I think it's pretty much baked in the cake that we're going to have a melt-up, and I believe a bust following that melt-up, or a big bear market and a global bust. But Trump's policies are dramatically different and dramatically, I think, helpful to the economy longer term in terms of basically moving us back towards a capitalistic approach to things. Less government, definitely trying to take the fat out of the government, less regulation, definitely going to see, I think, some pretty aggressive deregulating. And all of that gives me some hope that on the other side of the bust, we could see a very strong recovery cycle, and it might head off some things. With AI, we might see productivity improve enough that we can hold back the inflation. My whole scenario is that a global bust, which is the result of decades of overspending and decades of overborrowing and massive leverage on the system, combined with a policy error on the part of the central banks of over-tightening because they're so worried about inflation, we can get a real crack up in the economy and in the stock market, leading to a response from the central banks of massive money, bigger than anything we've seen. So bigger than the 2008-9, certainly, bigger than the $5 trillion that the Fed had to do in 2020, 21. This time, I think you could see as much as $20 trillion out of the Fed in QE and new money in a response trying to stop a free-falling financial system. It's that money that can jumpstart the next recovery, but also jumpstart an inflation cycle that will go way beyond what we saw this cycle and even much higher than what we saw in the early 80s. What I'm saying here is that maybe there's a fighting chance that Trump's policies might at least soften that and allow the cycle to extend beyond what I see. But at least right now, I think the macro trumps Trump. The macro is much bigger factor than even his policies. So although I'm very supportive of what he's trying to do, and I think it gives us a fighting chance, we've been doing this so badly for so many decades. Even his aggressive policies may not be enough. No matter what their best intentions are, I think we are going to see massive stimulus. And initially, it'll be massive effort to keep a financial system from breaking. It'll be basically in a tailspin that they have to first stabilize, then get turned the other way. But with a lag, that will lead to, I think, a recovery cycle that I think this is where his policies kick in, will be an industrial-driven cycle, unlike what we've had for the last 4 decades, which has been consumer-driven, service-driven. We're going to be seeing a lot of reshoring. We're going to be seeing the need for commodities, et cetera, to, you're building factories, you're building your industry back up. And I think that leads to a commodity cycle because of the demand for commodities. And what we run into is that we've spent many decades kind of moving away from that capital-intensive, commodity-intensive business. And the commodity companies have been rationalized down. Their capacity has been rationalized down to meet the new demands of the last many decades. Now, all of a sudden, because of the macro, the big pumping of money and fiscal increases, and because of the policy moving back towards reshoring, that's all going to force demand for commodities through the roof. And you're going to have limited capacity because capacity has been rationalized down. And then you're going to have this big boost in demand. And so you're going to have demand far outstripping capacity. And of course, in commodities, it takes years to develop new capacity. So you're going to have a situation where the only thing that can give is price. And that's why I think you can get very high inflation is, you can have demand outstripping supply and price going up. In the shorter term, meaning the next 6 months, I'm a huge metals bull. So I think gold's on its way to 3,400. That's my new target. I raised it from 3,000 a short while ago. And silver, I have a target of 75. It's a long way away. I think we've had this pullback here, this correction of late that is running its course. And I think we will see, both of them move to new highs for this year and then keep going. And that will be driven partially by the dollar. The dollar looks like it's rolling over. I think it's going to roll over hard. I've got an 82 target on DXY. As I said, it's, currently just under 107, maybe down towards 106. So that's a big drop from here. So the dollar will help the metals. Interest rates, I think, are going to fall, as I said before, pretty hard. So that'll help the metals. And then the whole idea that the Fed has begun a long easing cycle will also be a wind at their back. So I think you get this run, and then ultimately, the bust interrupts that. So you have a big correction after that big run. Silver might come all the way back down here. Gold might go from 3,400 back to the mid-twos or even back to 2,100. So you'll have a good size correction and another re-entry point there. And then the real story is the post-bust period where I see gold going to 20,000 by early next decade, silver to 500, copper will be through the roof. I think copper can get up to $6 pre-bust, meaning the next several months. Then after the bust, copper might fall all the way to $1 because it's so cyclical in the bust. And then after the bust, it easily could go, who knows, $20 might be possible. First of all, I understand, like I said, from a long-term standpoint, we're close, but close in time and yet still 25 to 40% upside from here. So my first thing I tell people is you have to understand yourself. And, you might say, because I've heard lots of people say, I don't want to risk, going down the other side of the mountain. So I'm going to get out early. I'm not smart enough to pick the top. And I get that. But just know that if you get out now, the typical investor is going to be compelled to be back in before this thing rolls over. Because if you have a run where you're up 25, 30, or 40% in a matter of a few months, that's going to be psychologically very compelling because that's how psychology works on investors is if it's up, they're bullish. If it's down, they're bearish. And if it's up a lot, they're going to be very bullish. So you can say, big picture, I'm going to get out now. And then if you miss 25, 30, or 40%, this story at the top is going to be compelling or you wouldn't be there. I predict the story is going to be, the Fed's got a lot of room to ease. Things have slowed down. Inflation's rolling over. The cycle looks like it has several years to run. This is not the time to get out. That will be what will be at the top. So understand it's not going to be, there's no bell that goes off. There's nothing, you're not going to be sitting there 25% higher saying, oh, I'm glad I got out. You're going to say, I got out and this looks like I have another 50%. So know yourself. If you have that discipline to say, I'm not worried if I miss a lot. I'm like you say, it's the end of 40 years. If I miss a year of it, big deal. If I miss 6 months of it, big deal. If you're like that, maybe you can get out and rest easy. But for most people, that is going to make a difference when it runs. And so if that's the case, understand that, yes, a few months isn't very far away, but 25 or 30% is a lot of money to leave on the table. That's usually, let's say the Russell, which is almost 40% from here. That's basically 2 or 3 years worth of returns, even if it can come in a few months. So that's first, is kind of know yourself and figure that out for yourself, how you'll behave if that's what happens. And then the other big thing is this whole buy and hold attitude we've had for probably 30 years from the mid 80s. The mantra for most of the financial advisors is you can't time the market. Nobody's smart enough to time the market. So it's time in the market. It's buy and hold. And that's worked great. If you just put your money in an index fund 30 years ago, you're sitting pretty. You made a lot of money. The problem is the environment going forward is going to be the opposite kind of environment. Instead of rates coming down for 40 years, rates were 15% on the 10-year back in the early 80s, and they got down to 0.4% in 2020. We have one more run where I think you can get to zero, so maybe even a new lower low on rates. But once that happens, we begin a big bear market in bonds, and rates will be going from that zero level on the 10-year, where by early next decade, I think they'll be close to 20%. That's damaging to index funds because index funds depend on PE multiples expanding. The reason you did so well the last 3 or 4 decades is because PE multiples were expanding because rates were coming down. When rates are going up, PE multiples will shrink, and you'll go back from 25 times earnings to single digits. And it'll be very hard to overcome that shrinkage in PE multiples, even if you're in an index where earnings are doing okay. So it'll be the complete opposite environment. And then it's a stock picking environment where index isn't the name of the game. It's more what types of stocks will do well in inflation, what types of stocks will do in an industrial recovery. And then it's commodities, it's Caterpillars of the world, big heavy industry, etc. There'll be other things too, but it'll be a very different leadership and a very different kind of approach to investing. Bonds won't do well, so 60-40. Bonds in an environment where the interest rates are going sky high, bonds will get hit hard. So 60-40 doesn't do you very well. What will do well, you can have 60-40, but that 40 in bonds, instead of being in 5, 10, 15, 20-year bonds, you'll be best to be in treasury bills and rolling them every 6 months at higher rates. That way you're refreshing the rate as the rates go up. It will take a different mindset, and I can promise you right now that most financial advisors aren't going to be there at the beginning. They're going to be looking at what worked before. It will, over time, that's what people will gravitate to. But if you want to be ahead of the curve and benefit when, things change, you're going to have to think ahead and understand it's a different environment. And then ultimately, in the bust, which is before the next cycle, in that bust between this cycle and next cycle, you could have an 80% bear market. And so, again, it will behoove you to not be a buy and holder, but say, I've done well. I want to take something off the table and prepare for the next opportunity.